All right, so what we're going to do is we're going to run down the questions that we have here that were typed in. If you have any questions along the way, feel free to let me know about those as well. You can type them right here into the chat. I will make sure I pick them up. On the bottom of the chat, just make sure you choose all panelists and attendees so that everybody can participate in each other's questions. This way we all learn from each other, and the questions will go to everybody, or the comments will go to everybody instead of just coming to me directly. So we're going to just start right at the top. We're going to go Richard Croxford. How you doing, Richard? Following the concept of an inside candle indicating a stock may move to well bid, is there an equivalent indicator suggesting that the stock will turn downward for an early entry on short positions? Yeah, I mean, you kind of answered the question there yourself, Richard, and it really comes down to well offered, which is a short sell in the opposite direction. But just as specifically, it's kind of interesting that I happen to have up my market internals here on the screen. So you typically watch the VIX, the tick indicator, the trend, as well as the SPY. So I'm watching the market and the market internals. So a big part of that is basically paying attention to how the ticks, the VIX, and the trend are trading in relation to when you get well bid or well offered candles. So if somebody happens to be on the call right now and you're not sure what well bid means, well bid is this. This is probably the best illustration of it here, where you have higher highs and higher lows, and that's on a daily candlestick. We have the same kind of indicators on the intraday ones, but specifically in reference to the question posed by Richard here, well bid is an indicator that an inside candlestick breakout will go to the upside. The same thing on the downturn would be a well-offered candle, which is what we have here, which is lower lows and lower highs. Best case scenario is actually if it's closing near the lows, kind of like we have over here. But just as significantly are the indicators. So intraday here, you can see the VIX really didn't do much today, but yesterday, and specifically in the afternoon, as the VIX rallies, price usually moves lower. So the opposite would be the case. As the VIX rallies, prices move lower, which is what we did see in the market yesterday afternoon. So let me pull up a 5-minute chart from yesterday, because that would be a little bit better indicator. So you could see here, Richard, in the afternoon, that while the VIX rallied in the afternoon, so you can see here was basically from 3 o'clock to 4 o'clock, which you saw here, the inside candlesticks broke out to the downside as the VIX advanced. So that would be kind of a advanced indicator to, I guess it's not really advanced, it's really more tape reading, where something actually, here's the best way to word it. It's a confirming indicator, not an advanced, or advanced, because the question said advanced. There's really no way to know an early entry. It really comes down to paying attention and having the side of the market be obvious. So I hope I answered that question clearly. Let's see, Jane, the best way to do it is exactly the way I have it here, is to have a 5-minute chart of the tick. Now, what's important here is to be using the correct tick if you happen to be using TradingView. Each software actually has different symbols for the tick. So for example, if I type in tick here, you'll see that there's a whole bunch of different ones. The one that we use is the top one here, which is the New York Stock Exchange cumulative tick. And we watch it on a 5-minute chart. So as we've been discussing, you're not watching every print. I think that's a very common, let me actually pull this out so it's easier to read. I'll pull it on a 1-minute chart, and a one chart. And we're going to watch that on the 5-minute chart. And I'm not sure why that's happening. Give me 1 second. And we'll watch on a 5-minute chart. So the biggest misconception about the tick readings is people think that it's too confusing because it's all over the place and it's not really trending the same way that, let's say, stocks do or indices do or anything along those kind of securities. I'm drawing a blank. So what we're really looking for here with the tick is on a 5-minute chart, we are mostly looking for the extremes or the neutral. So for bullish indicators, positive 1,000 or above is a very strong indicator. And that kind of confirms that we're seeing more upticking stocks than downticking stocks. The zero line tells us the bias of the ticks all day. What's kind of interesting for this, and specifically going out to today, you can see that the ticks were on both sides of the market. They were all over the place. So there really wasn't a strong bias of a bullish tape or a bearish tape. So to keep the ticks as simple as possible, you're looking for plus 1,000, negative 1,000, or the zero line. And that's really it. You're only looking to see where it is in relation to those three numbers. It's going to tell you it's really obvious bullish, really obvious bearish, and where it's neutral. And like today, actually, for example, we were hanging around the zero line for quite a bit today, and the market kind of just kept drifting sideways. So what's important to remember also is if you happen to see tick readings that barely can push past positive 500 or negative 500, those are usually days where there's absolutely nothing going on, and it can be very choppy. And if you recognize that while it's unfolding, you tend to stay away from the market, that you will not get follow through, and you keep money in your pocket. That's a big part of reading it. So Jane, I know you remember the boot camp, so I will make sure that I keep pointing that out during the day, but I can't stress it enough. It's actually a lot easier to follow than most people think. So again, just to reiterate it. So again, I'm very big on what am I supposed to do tomorrow? What do I do tomorrow? It's really plus 1,000, minus 1,000, and zero. That's really all you're looking for, and the relationship to how it pushes up to those numbers, okay? So I'm going to continue with Richard's questioning here. All my other charts are set up correctly, and also he has a question about the tick. So really what it comes down to is I believe that he's looking at the wrong tick indicator. As I just said, there's a lot of different symbols for the tick indicator, and those even vary based on the software that you're using. So it could be the same indicator, but a different software platform. So what Richard has here is he's not getting the same looking chart. And I'm willing to bet that it's either a different symbol he's using, or he's not subscribed to real-time data. So Richard, this is the exact tick that we're supposed to use. And this is what it looks like on the FinViz charts, so that, TradingView, so that you can get an idea of what it looks for. And I have it here on a 5-minute chart. So hopefully that was a pretty good explanation. So let's see, Jim, I have it displayed goofy too. Sometimes you actually have a moving average on there too that messes it up. So make sure that there's no moving averages or anything on there. So it's a 5-minute chart with real-time data and the New York Stock Exchange cumulative ticks. So let's see. I will tell you this. I'm going to stick on this for a second because Jane and Richard both asked questions about this. What's interesting about the ticks is not only will it tell you when to be more aggressive, it will also tell you when to do nothing. And it's a little hard to see sometimes after the market's unfolding, because you really want to watch it almost tick by tick. And I hate to use that phraseology, but you want to be like, okay, that's where the tick is. So it's a little bit easier to see here that the tick, okay, it's having a hard time getting above 4 or 500. Then you go to the next candle in the tick. So another 5-minute window, and you can see it's basically, again, between slightly negative and 500. So during this window, which is around 1:30 in the afternoon, there's not much going on. And then you pull up another 15-minute window, and it can't even get past 400. So you start to see how this actually unfolds during the day. And it's really one of those indicators where I'm not staring at it all day. It's not like you should be watching like time and sales or anything, everything along those lines. But now that we're going bar by bar, you can see, wow, it's kind of obvious as it's unfolding. So in this 15-minute window, there's really nothing going on. It's not pushing down to big negative numbers. It's not pushing up to 750, 800, or 1,000. And then another 15-minute window where it can't get past 500. So you start to see, you're not watching every tick of the tick. You're just watching to see if there's any extremes. You're like, okay, so now it is, let's see, this is now about 1:40 in the afternoon, maybe a little bit after that, 1:55, almost 2 o'clock. You're like, okay, a little bit stronger positive tick readings. And now you go to the market and say, are price action confirming what I'm seeing in the tick reading? And then you move along again, and it can't get past 500. So immediately it's telling you, okay, just scale back. And if you were in our community today, you kept hearing me say, today's a day where you have to be a really stock specific tape reader, because the market itself is not really helping at all. And you saw that in the SPY, where we were just kind of drifting all afternoon, and that's what was going on. So you could actually tell what was going on in the market without even looking at the market, just by reading the tick indicator. And if you're new to using the tick indicator, it basically measures upticking volume versus downticking volume, and it gives you a number. So if it says plus 500, for example, that most likely means that 1,500 stocks were on an uptick, and I'm just using these numbers, so it's simple math. 1,500 stocks uptick and 1,000 stocks downtick, and that gives you a plus 500 reading. So it's kind of easy to use once you understand you're not watching everything and you're not looking for it to trend. You're just looking for the extremes there. So James, thank you very much for helping out on that as well. So let's see, Maureen, a couple of questions. What do you normally write down in your trading journal? Very, very good question. And I'm going to post this link in here for everybody. This is a very big deal, writing in your trading journal, because it's your personal experience about how to get better. So I'm actually going to post this into the chat here as well. So everybody has this link. You can watch the videos at your own time and pace. But it's interesting. I have 3 different times to write something in a journal. One of them is before the market opens. And if you're a part of the community, you know that's all about writing out your game plan, how you plan to trade the open based on how a stock closed yesterday, what it's done over the last day, week, and month. Then you have what you write during the day. And I think this is one of the most underutilized journal entries, period. I think that a lot of traders tell me, and especially when I had my firm, I would have traders tell me, oh, I'm too busy during the day. You know, traders who are brand new, not even making a dime yet, telling me I'm too busy to write in a journal. I'm like, really? You're too busy to be successful? That makes no sense whatsoever. You don't write a book during market hours. You're basically writing bullet points of your thoughts. And I'll give you an idea. Again, you can watch the video, but it basically comes down to, what is the market doing? How are you reading the market? And then what are your trading expectations while the market's open? The reason this one is so massively important is because I'm going to tell you right now, it's 4:47 p.m. There's no way in the world you're going to remember everything that was going through your mind and how you felt at 9:50 in the morning, 20 minutes after the market opens, and all of the reasons that you are looking to put a trade on. Now, something that's actually kind of cool too, is if you actually have used Google Chrome, and you open up a Google Sheet, it will literally transcribe what you're writing. So you don't really even need to type, for lack of a better way of putting it. You can literally just get in there and create a document just by talking, which is kind of really cool if you think about it. So if we pull up a journal in here, I think it's under tools. So this is just a regular Google document. And you go down to voice typing, you just turn that on, right? And you click to speak, and you have this open on your computer, wherever it happens to be. And I think you have to use Google Chrome, not Mozilla or one of the other web browsers. You basically just click that, say aloud to let your microphone use it, and you just start talking. So today I was trading Microsoft. The stock was moving higher. It was well bid on the 5-minute chart, but the VIX reading wasn't trading well. So essentially what I did was I built a position instead of jumping in one shot. 11 a.m. That's as simple as that to be able, let me shut it off. It's as simple as that to be keeping a journal while the market's unfolding. So believe me when I tell you, this is massively important, because this is where the market's open. It's what you're thinking, what you're seeing, and exactly how you're reacting and making trading decisions. You will be amazed at how many different things that you say when this is unfolding, and when you read it at night after hours, you're like, oh my gosh, what in the world was I looking at? And you start to catch yourself out. I'll give you like the ultimate thing that in your trading journal that you never want to see. You can be like, okay, Facebook is screaming to the upside. The market is really strong, but it started to slow down a little bit. Everything is bullish today, but the stock slowed down a little bit. So I'm going to try and sell it short and catch the top. Obviously, we all know that that is just the worst thing you could possibly do, but you will be surprised at how often you do this without even realizing it. And I remember when I first started trading, and even for the first 4 or 5 years I was trading, when you start to write this down and you read it over the weekend, you'll be fascinated at some of the things that you actually say to yourself. Luckily today we have this beautiful, amazing software that you don't even have to type. You can literally just talk and then read it at the end of the day, put your date in there and all that kind of stuff. It's pretty darn cool. Okay. All right, so we're going to move on to the next. So I posted that link in there. Everybody can take a look at that when you get a chance. There was one other question. Do you use ATR as a guide on risk management for day and swing trading? I only use ATR as a guide on day trading for profit potential. I don't use it as risk management. However, in reference to this question, what we're going to do is we're going to put a indicator on the screen here. So we're going to go over here and we're going to go to average true range. And this is kind of something that's very cool that it kind of makes a stop loss no-brainer. So you can see here looking at the SPY, and we have a 5-minute chart of the SPY, and we just added the average true range. So this is actually the average true range of the SPY ETF on a 5-minute chart. So if we go over here and hold it here, the average true range in this particular moment is 93 cents. So you can see the reading over here. Over here, it is 97 cents. Over here, it's 78 cents. So what I have seen, Maureen, people do, which is, I think, quite honestly, I think very smart. I think a lot of people use this with algorithms or automated trading when they do it. If you're allowing the machine to make trades for you, get you in and out of trades, I personally think using the average true range is a great way to come up with absolute numbers that that each individual stock has different numbers. So you're allowing profit targets and stop losses to be dictated by what the stock normally does, whether it's a day trade or not, but risk management. So in this case here, let's just say for argument's sake, at this moment here, we use a 2 times average true range of the stock and 6 times average true range for profit potential. So if we trade, let's just say for argument's sake, a breakdown, we now have a 2 times ATR, which in this case here at this minute is 95 cents times 2. So if it rallies on a short sale, that will take us out at 2 times the ATR. And then as it moves in our favor, we'd be looking at 6 times the ATR, just using very clear numbers. So it's a 3-to-1 risk reward ratio. So it's kind of cool to be able to do that. And just to give you some context, so let's say over here on this 5-minute chart of the SPY, the average true range is 94 cents. Let's say we type in Goldman Sachs at that same time during the day. Right here, of course, it's the same exact number. Not a great example, right? So over here, and DocuSign is $1.67, $1.73. So you get the idea. You're actually letting the price itself tell you what the stop loss would be in a stock based on how much you're willing to risk per trade, per stock. So it's kind of cool in a way, Maureen, to use ATR on the entry time frame to determine your stop loss and your profit target. So let's see, move along. Janice, how are you, Janice? What do you look for in a stock besides movement that helps you decide the stock can be on your personal watch list versus stocks that come up in the nightly scans that may not be in your list? What is the best method to study the personality of a stock to gain confidence in the stock? This is actually a really good question. And first off, I have criteria, and the base criteria that I have is 2 million average shares traded per day, and then an average of 1.5 average true range per day. So if we go into FinViz and we go to Screener, I'm going to pull up what's called my template. So that's Pete's template, right? So you can see here, it's stocks only, average volume of 2 million shares per day, average true range of $1.50 per day. And that brought up 269 stocks. So now I want to break it down even further. I only want to trade stocks that were strong, let's say for the last month. Again, just to break this down even more specifically. So if we go over to performance and we say month and we say, let's just use 20% as an example. So I want to trade the strongest stocks over the last 21 days that meet this minimum criteria. This would be where I would start. So 29 stocks meet that criteria. So if we go over here to month and we sort it by profitable, we know that all of them are at least 20%. So now what would I do? I would look to see, are they stocks that match me from a dollar perspective? We know that they meet the volatility and the volume criteria. Now I would need, as Janice said, I would need to watch them. If I've never traded a stock before, and I'm going to get very specific here into Janice's question. I'm sorry, I said Janet. Janice's question. What helps you decide the stock to be on your personal watch list versus the stocks that come up in the nightly scans? Well, first of all, the stocks that come up in the nightly scans are the stocks that come up in my watch list. So it's a question of, and let me go back over here. These are not my updated list. This is a list from a while back. But this would be the criteria, what I call my universe. These are the stocks that I trade every day. They're non-correlated. They don't have anything to do with each other. They're just liquid stocks that I call market stocks that follow the market. Then I run scans, and I'll notice, NEO is not really the best example. I want to say probably something like BEKE. Let me use that one as an example, where it wasn't in my list at all. Obviously, it's a newer issue. Let me get this indicator off the screen. It's a newer issue, but every single day I started running my scans of stocks that met that same criteria, and it was strong. And it was strong. It was giving these 3 to 4 to 5 days of well bid in a row. And I'm like, wow, I've never heard of this stock before, but it's coming up every single day. So I watched it for the month of September. I started to trade 100 shares in a stock that I've never traded before during the month of October to see how it traded. How does it follow through? How does it skip levels? I'll give you another example, OSTK. I never traded it before, but we would do it. Members of the community were trading it really, really well earlier in the year from April right through August. And right around this time when members of the community kept saying, it kept coming up in scans, how do we watch it? How do we watch it? I started watching it, and all of a sudden I was noticing, it would be, I'll just use 5134 as an example, which you can see here. It would be 5134, and then in the blink of an eye, it would go down a little bit, and it would be 51. And I'd be like, whoa, the stock has no levels. It just fell 34 cents in one print. So that meant to me that the stock was a little bit more challenging to trade from a size perspective. So when I started to trade the stock, I was only in there with 100 shares, 200 shares, 300 shares, building positions as opposed to going in with 2,000, 3,000, 4,000 shares, because it sounds exciting when a stock moves $10, but if it drops $2 in the blink of an eye and you're down $4,000, that's not that fun. So to answer Janice's question in detail and getting along, it really comes down to, you have to first run your scans to find stocks that meet the criteria. Then you have to determine, then you actually have to watch them. Maybe I'll put 3 of them in the list. Maybe I'll put 5 of them in the list, and I'll watch them. I'll see how they trade. I'll keep cycling back to them, and then I'll start trading them if they trade well. And when I say trade well, quite frankly, I don't like to trade stocks that could move 30 cents in one click. I want liquidity. I want to be able to bang out of a position size at where I want to, as opposed to if I hit the bid and get out of the trade, I drop the stock $2. That's not what I want to do. I want liquidity, I want institutional activity, and I want to have a fairly good idea where it can get out of it. So Janice, it really comes down to, you have to first run your scans, you have to watch the stocks in your watch list, you have to see how they trade on the charts, then you have to start trading them. Some of them you might find match your personality, some of them you might find are moving too fast and you can't trade them at all. So it really comes down to, there is no shortcut. You have to do the scans, watch the stocks over a week, 2 weeks, 3 weeks, and then you have to jump in with lower share size to see if you're getting the fills on those stocks that you think you might get just by watching the stocks. So this is a really good question, but something else I want to bring up that is kind of important, which I mentioned before, this is not my current watch list. It's very common, and I'll use OSTK and DocuSign. We could even use DocuSign as an example. You can see here on the monthly chart how obvious this stock was for a while, and we're trading it basically every day, and it was honestly relatively easy to trade. The weekly chart started to tell a little bit of a different story, and the stock is now out of my list. The weekly chart, the tape changed, and I'm like, this stock is hard to trade now. It's not following through. It's not obvious from day to day. I'm done trading it until it gets clear again. So the obvious question before anybody asks is, well, how do you know when it's hard to trade? Anybody want to take a guess? It's a really obvious answer. It's a really obvious answer. When should you take a stock out of your watch list? Come on, participate. When should you take a stock out of your watch list? Okay, Jane says not well bid. Nope, everybody's wrong. When you start losing money, there's no other way to put it. We were printing money, and I say that in context. We were printing money here because it was obvious. All of a sudden, the tape changed, and it was really, really hard to trade. When you are continuing to make good trades, or at least trades that look good in that moment, and for whatever reason, all of a sudden, you just can't get a read on the stock anymore, assuming you don't understand tape reading, you have to stop trading it. As soon as a stock starts to become hard to trade, I take it out of my list. I'll give you an example. The solar stocks were incredibly easy to trade. And now, obviously, now you can see here why. But all of a sudden, the tape changed. And this is a weekly chart. We go down to the daily chart, you can see it even more dramatically. It's not obvious anymore. And even if you wanted to sell it short, it's still not obvious. When you're making good trades, or what you believe to be good trades, or what you believe are the same trades that you made money in, and you're not anymore, and that stock is just beating your brains in and you can't figure out what you did, that's when it comes out of your list. And as Janice said, you start to study the personality of a stock and start to put it into your daily watch list. So basically what I'm saying is all day long, I'm adding stocks and removing stocks, adding stocks and removing stocks, excuse me, not all day long, all week long and all month long. And it really comes down to how well I'm trading those stocks. Sometimes it's the stock, sometimes it's me, but again, I can't stress this any other way. You need to scan first for stocks that meet the criteria, then you need to watch them, then you need to trade them. But the key here is you are out of your gourd if you trade a stock you've never traded before with size. If you want to take this business seriously, and I know that's a really strong word, but if you want to take it seriously, you can't jump into trading stocks you've never traded before with size because you just don't understand how you're going to get a fill. So in other words, if you try and buy on the offer, do you get filled immediately? So let's say you're buying stock, you're actively going to get it and using a limit order to buy on the offer. Do you get all the shares immediately, or do you get, try and get 1,000 and do you get 200 and then it jumps 5 cents on you? And then you try and do it again, you get 200 and it jumps 5 cents on you again. That's not a stock you can go in with size. So you have to know the trade. You have to know the stock before you trade it. And really, Janice, the best way to do that is you actually have to trade it. But the point I want to get across here, again, you can't do it with size or it'll be very challenging for you to really understand how the stock trades. Okay. One thing I want to point out here too was asked yesterday in our coaching call. If I go back to here to the template, and it was a very smart question. There's so many stocks that meet the criteria. How do you decide which ones how do you whittle it down? And it really comes down to you need criteria to determine which stocks you want to trade. So what we talked about yesterday was, what is your time frame? Are you a day trader just looking for the next move? Are you a swing trader looking for the next 3 to 5 days? Are you looking for the next month? Are you looking to buy on October 1st, get out October 31st? That's going to dictate what performance you're looking for. That's going to dictate that. So if we're day trading and we're looking at, and we drop it in here again and we go to week, let's say that we want to just look at the last week for 10%. So that dropped it down to 131. So if we go down to the last week, and now we're looking at stocks for tomorrow, we're looking at 10% for the last week and up 2% from the open today and up positive. So that brings that all the way down to only 23 stocks. So now you have 23 stocks to consider for tomorrow. So then you would take this list of stocks and you get a feel for whether or not they're overextended. Are they fuel candlesticks breaking out? Are they in 5 weeks of selling versus 2 days of buying? And that's how you start to find your best opportunities for the next day in that very tight window. So it sounds like it's a lot of work, but you know what? It's really not, because really what we're doing is we have the minimum criteria, and then we're looking for ideas that have obvious smart money in the time frame that we trade. So again, if you happen to be day trading, and that's all you're doing is day trading, You could use these same signals where the only thing that matters is it positive from the open price, and you just choose to be buying above the open price. So really, the list and the size of the list has to start with the stocks that you like to trade or want to trade that you wrote down in your trading plan. So Janice, it's interesting, Janice. There's so much more I could say about this, but I don't want to confuse you, and I don't want to confuse anybody on the call. It really comes down to the process of what is your criteria, scanning for those ideas, watching them, and then dipping your toes in until you learn how to trade them. You know, it's funny, this is actually one of the most interesting things because I give out signals all day, every day, all day, every day, all day, every day. But I have 20 years worth of experience, so I can watch 100 stocks and know what to do and how big I should trade them, how small I can trade them. Somebody who's not profitable yet, again, I talk about this every single day. You should only be trading your personal game plan because that's the one that you built. I'll be calling out trades in your ideas if you called out those ideas in our game plan in the morning, but you should only be trading your game plan. That's where the confidence comes from. So Janice, this is a really important part of being successful because conviction is going to come from you did the homework. And just the fact that you answered that question tells me that you want to do the homework because you want to know exactly how to do it correctly. So that's a really good question. Let's see. Hey, Jim, how's it going, buddy? The better I prepare for the opening bell, the less stress I have. Awesome to hear. I can't say definitively, but I'm going to say that Jane also is feeling that way right now because in our coaching call last night, we really, really dug deep into reading the tape in the most recent time frame, using the watch list properly, and setting yourself up for the morning. So that's a huge part of the day, owning that early part of the day. But I can still get the FOMO fever. Any tips or advice on how to calm that beast? Yes, 100%. So if we go to the charts again, and let's actually start looking at, let's take a look at, gosh, what's a good stock? Let's just look at Boeing. This will be a good one, right? So let's say for argument's sake, Boeing just did this, right? Which it actually 100% absolutely did, right? This is chasing. And the further away you get from the optimal entry, and if we go back to the SPY today, and specifically the 5-minute chart, the further away you get from the optimal entry, and the more you trade when nothing's going on, the more money you're going to throw away. And I'm telling you, Jim, you might even know this already, but the more patient you are, actually, you know what? I'm going to reword this. I'm going to reword it in a different way. We all know there's going to be losing trades. Everybody knows that. Anybody who says, who goes crazy about, oh my gosh, that trade lost money. Oh my gosh, that trade lost money. You're fooling yourself if you think that you're never going to have losing trades. So let's just assume that we're all super educated traders right now, and we all agree there's going to be losing trades. And that's losing trades within the context of you love your strategy makes sense, which our strategy obviously is order flow, and you believe in it wholeheartedly. This is going to sound like an oxymoron, but it's not really. It's just fact. You always want to set a goal. If you're going to lose money, it's on your best ideas. You never, and I don't want to use double negatives because it kind of gets confusing, but I'm going to use one, say it now anyway. You never want to lose money on bad ideas. Because if we already accept the fact that we're going to lose money even on our best ideas, because that's just the very definition of having an edge in probability, as soon as we start making bad trades, as soon as we start making trades because of fear of missing out that don't meet our criteria, you are literally pushing yourself further and further away from being profitable because you're messing up with the edge. So Jim, if you could think about within the context of, you expect to make money because you're in control. So you have no stress because you know what you're doing and you know what you're looking for. As soon as you get out of the reason you don't have stress, which is you're getting your fear of missing out and you want to do something, or you want to trade when nothing's going on, you're literally wrecking the algorithm in your mind. You're literally throwing bad trades into the mix, and that's going to take you further and further and further away. It's kind of one of those things where, and I don't know for sure, but I'm going to tell you I had this experience until I finally figured this out. You're not losing money anymore, but you're not making any either. You get to the point where you're making money, losing money, making money and losing money. Your account's not bleeding anymore, but you're not making anything. It's staying away from the fear of missing out. It's staying away from taking trades that don't match your edge, that are the reason you will ultimately be successful because of those trades that you followed. Exactly, John. 10 perfect trades. Exactly. So I can't stress this enough. And, a lot of people ask me in the boot camp specifically, how do you get disciplined? How do you have so much patience to not feel compelled to trade all the time? And that's why. When it really comes down to the fact that the reason you're not getting paid is because you're trading too many bad ideas, you're trading too many trades that because you had fear of missing out or because you're bored, those are the reasons you don't get paid. Make no mistake about it. And anybody who's in the boot camp right now, especially if you've been in the boot camp for a few months, it is easy to make money when it's obvious. It's not throwing money away. That's the challenge. When you understand those trades are the reason you don't get paid, that's where you don't need superhuman discipline anymore, because you're literally just saying to yourself, why would I take those trades? I want to get paid this month. I want to take every single trade that matches my criteria, learn how to manage my winners, be super disciplined on trades that aren't working out, and over time, the edge will pay me. That's the difference between trading and having fun versus trading and stressing yourself out of your mind because you think you're doing something. I got news for you. You're not doing anything. You're not. If you have the strategy already and you place the right trades, the edge is doing the hard work. You just have to not mess it up by taking trades that only match the edge. You take the good trade, take the good trade, take the good trade. It's those trades that you know you shouldn't trade that really shoot you in the foot. Again, I'm telling you, Jim, and everybody else who's listening right now, when you fully internalize, I'm not going to say understand because it's the wrong language. When you fully internalize that we're going to lose money on even good trades, and that's the only way we're going to make money. You have to automatically, you're like, I'm not taking any trade that doesn't match my edge. Why would I? You're literally saying this isn't how I expect to make money, but I'm going to take the trade anyway. Yeah, Jim, you want to know something? 100%. I don't know if everybody can see that question, but 100%. So maybe make a list of bad trade ideas and put it on a Post-it note. Yes, 100. Something as simple as I'm not going to trade a stock if it's below the opening price. Super exaggerated, but yes. If you remember in Reminiscences of a Stock Operator, Edwin LaFay, Jesse Livermore very specifically said, I made a big list of what doesn't work, and what was left over was how I got paid. You want to write something on a Post-it note, put that on a Post-it note. Because I went through the same exact thing. I took that advice that he said in the book and I took it to heart. And I'm like, okay, that doesn't work. Don't do that anymore. That doesn't work. Don't do that anymore. Now that's different from doing what you're supposed to do and having a losing trade. We understand that's a part of the process. But he literally said, and I can confirm it, you make a big list of what doesn't work and what's left over is how you get paid. 100%, Jim. 100%. Great way to word it. And you actually brought it back into my memory. Okay, so we're going to move along. We're going to Jennifer. How you doing, Jennifer? Wondering if it is okay, not ideal, to keep an eye on the market for the opening 15 minutes rather than jumping right in. Jennifer, 100%. Actually, Jeff May in our community does that. He generally waits for the opening 15 minutes to unwind. Obviously, everybody has different experience levels and different goals, but 100% this is okay. And I'll give you what's a funny story now, but not a funny story when it was happening. I didn't know about the opening range breakout when I first started trading. I didn't know about being a little bit more patient on the open. But in those days when you were trading for a firm and trading their capital, you would actually have a stop loss for the day. If you lose $500 for today, that's your maximum downside. We're cutting you off. You can come back tomorrow and go at it again. So there was always a risk manager. So Jennifer, when me and a lot of other people would trade early in the morning, we'd be like, okay, right out of the gate, the bell rings, ding, 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 and you buy something right away. You're like, I know this thing's going up today. I want to get into stock early. And of course, there's a few times the stock turned around and went down on us, and you hit that negative $500, and say the market opens at 9:30. And you lose $503 by 9:35 because you were traded like a dodo bird. And you know what? You're done for the day. There's no talking them out of it. There's no, oh, just let me know. I know the stock. You were literally done for the day. They sent you home, or if you were new, they would make you just watch the market the entire day and you weren't allowed to place a trade the rest of the day. So that opening window, it's not a bad idea to let it settle in. And if you notice during the day, very rarely do I call out a trade for the community until at least the first 10 minutes are gone, so that we have definitive idea of what's going on, definitive opening price, and the first kind of momentum of the day. So yeah, there is absolutely nothing wrong with doing that. Absolutely nothing wrong. And you want to know something? Lacking confidence at the opening bell, specifically with speed. Honestly, that's a smart comment. Honestly, Jennifer, that's a smart comment, because you know why? You're basically saying, I'm not going to drive in the left lane until I can. There's nothing wrong with that. You can still get on the highway and drive in the middle lane or the right lane. There's nothing wrong with that. That's smart, actually. Very, very smart. You want to advance at the pace and the volatility and the share size and the risk that you could make good decisions with. For some people that might be trading Bank of America, which doesn't move that fast, and they might want to wait till 10 o'clock in the morning. Other people might be, they want to jump in Tesla at 9:36 in the morning. Completely up to the person. But Jennifer, your comments here are impressive, because it really shows how much you're thinking it through. You're not just trading for the sake of trading. You want to be in control. That's the point. Nobody knows what's definitely going to happen next, but what you should know is definitely what you're going to do. That's the whole point of preparing and being ready for the open. And I'm telling you, I'm promising you this, the more time we spend together in the boot camp together, everybody that's in the more time we're together and the more different market conditions that we can discuss together, the better job you're going to be able to make distinctions and make decisions subconsciously as a habit. But right now it's A plus B plus C is how we all build the argument together. Once that becomes second nature, that will also open you up to trading more volatility, more share size, and quite honestly, more stocks at the same time, because you can process decisions quicker. So good question. Very, very good question. Let's see, Jim, as someone who's less than 25,000 in your account, okay, so a lot of people fit that criteria. I generally need to look at swing trades. If I cannot put on more than true trade, I've used 2 to 3 day trades are available. Eventually gets to the point where I run out of day trades. And buy at the end of the day, setting me up for the following morning of trading. Reasonable approach, or any other suggestions? So Jim, a lot of people are in this situation, and I personally think too many people jump into options trading because it's much bigger leverage. I prefer that you learn stock trading and trade stocks, which I'm not saying here. I'm just throwing this comment out in general from what I've experienced with people in the community and over the 20 years that I own my firms. What I would suggest you do is, I wouldn't worry about this. I would find trades that you plan to hold 3 to 5 days. Find the best opportunities. Don't let the thought process of day trading or the pattern day trading rule. If you know that's the funding that you have available for your business, then go and find trades that match the funding you have available for your business. And in case everybody hasn't figured it out, I've been an entrepreneur since 1988. I equate everything to running a business as a trader, which is also probably why I've outlasted a lot of people, because I've always treated the capital with massive, massive respect. But my point is this: use the time frames that match your resources. So in this case here, I probably wouldn't even be looking at day trading at all, quite honestly. I'd be looking for 2 to 3 good swing trades per week. Execute those trades and build your capital up over the month to eventually get to the point where if you want to day trade, then you can day trade, or if you happen to be in front of your screen. But I would flip the switch and focus on trades that you don't plan on day trading. So I would get day trading out of my mind. I'd be looking for stocks that meet all the criteria for order flow in multiple time frames. And then I'd be looking for the optimal entry to make 3,000 on a trade, 700 on a trade, 800 on a trade. Maybe you lose 300 on a trade, but then by the end of the month, let's say you do that all during November, you're like, wow, I didn't have to worry about the pattern day trading rule because I was only holding trades a little longer. And then all of a sudden you're like, wow, I just made an extra $6,000 without day trading, because that's the business that you could run now. And sometimes it's not only about money too. Sometimes it's about time. Sometimes people can't be at their screen all day long. So I prefer that you focus. I'm sorry, please take this the wrong way. I have no right to tell you what to prefer. From a coaching perspective, I would prefer you focus on the resources that you do have and look and stay away from the day trading timeframes right now, and grow your account with the resources you do have instead of worrying about this garbage affecting your mind. Okay. And I say garbage. I have a strong opinion on the pattern day trading rule. I'll give you really quick. I mean, let's use Jim as an example. Let's say Jim ran a bagel shop in New York, and he did that for the last 25 years. Now he's got $50,000 in his day trading account. How in the world does that make him qualified to be a day trader? It doesn't. It's foolish. It's absolutely foolish. If anything, they should make you day trade for a month to determine if you know how to day trade and use your results, not how much money you have in your account. It's pattern day trading rule, and the way they came up with it is just silly. Putting a dollar amount on it, that's basically just saying we're going to let you lose more money if you have no idea what you're doing. Take that rant, and that's an argument that I've been having with people for a long time. Okay. All right, Jim. Yeah. The only reason I say that is, look, I've been in that position early in my career. A lot of people have, and a lot of people still are right now. Look for trades that match your resources, and you'll find it a lot easier to find what you're looking for. Okay. Okay, Virginia, we do have a lot of videos on short selling, specifically here in the community. You could actually go into here and search it, but I want to point this out. Don't short sell. There's really no other way to put it. If something in trading, if you don't understand it, if you're not comfortable with it, and please take understand it as in the context of tonight's lesson, nothing about your intelligence or anything like that. We're just speaking from the context of trading. Don't do it. 100% don't do it. Only look for strong stocks that you have an opportunity to buy. Don't short sell if it's something that you're not comfortable with, or the concept is a little bit hard to understand. This is, Virginia, I'm not sure if you understand how smart, again, like I was saying about Jennifer before, this is you basically saying out loud, I probably shouldn't do it because I'm not comfortable with it and I'm not sure how to manage those trades. So take your own advice and don't do it. Don't worry about if the market's going down, if stocks are going down. Do exactly what I just discussed up here with Jim, which is only look for ideas that match your criteria and the way you want to trade, which means you should only be looking for stocks to buy that meet all the criteria that we teach in the boot camp. Okay. How to place a stop loss, one has to place the trade and then the stop and then go to work. Okay, so we're talking about you are not able to be at the screen during the day. Okay, so we've had this conversation quite a bit lately, mostly because of the wild gaps in both directions. And I actually think that Caterpillar is probably the poster child for this right now on the daily chart over this 3-week period where we were looking for a breakout here, gap down, gap down, gap down, gapped up, gapped up, gapped down, gapped up again. There's no other way to put this, and it has to be said as blatantly as possible. If you can't be in front of your screen to place orders, that means that you're swing trading, which means that you have to place your orders outside of yesterday's price action. That's really what it comes down to. So how to place a stop loss, one has to place the trade and then stop and then go to work. So in this case, Virginia, based on your availability to watch the market and your availability to place the trades, that's 100% okay. That just basically means that you're swing trading. And swing trades, 99% of the time, profit targets, entry signals, and stop losses are placed outside of yesterday's trading range. Now, typically it's yesterday's high and yesterday's low, somewhere below the low here for a stop loss, and somewhere above here to enter the trade as a buy stop to enter a position. Okay. Let's see. I'm gonna go to the questions in the chat here in a minute. So let's see. NLS was well bid and entered at $28 on November 6th at the stop loss. Previous low next day gap down to 22. So let's discuss why this happened first, Maureen, because we actually discussed this today. NLS is a weightlifting company. They sell weightlifting equipment. The only reason the stock was rallying was because of COVID. People were buying workout equipment for home. And after the election and coming back to work, the news from Pfizer got announced, and all of these stay-at-home stocks got absolutely crushed. And we did talk about this in this morning's game plan a little bit, or maybe it was during the day. I don't remember. But somebody was asking me, would I have bought this gap down here? So this is basically what we're talking about here to here. And the answer is hell no, because the story was much more than just a bearish gap in the direction of a bullish trend. The reason this stock rallied like this, the reason it rallied was COVID, and everybody was buying equipment at home. This day here, which was yesterday, Monday morning, the story changed. So it's not just a matter of buying, and I'm answering the question that was asked this morning on top of Maureen's question. You have to know that the story changed. So it's not, under normal circumstances, a gap lower in a bullish environment is typically a buying opportunity. But yesterday in this stock, in all of these COVID related stocks, it's not normal. Zoom, I think, is at the top of the list. It wasn't a normal move. The reason, the story, the catalyst reversed. So reviewing that trade, assessing the trade, I don't think there was anything wrong with entering a trade to get into the position prior to that. But after that, so in other words, if we go back to Nautilus, we were looking at Nautilus as a long here with good reason. Nothing wrong with that at all. You, me, nobody had any idea that over the weekend, news was going to come in and completely crush all of these stay-at-home stocks. So is there anything wrong with getting in here? No, we had no idea this was going to happen. So Maureen, I talk about this often, very, very often for people in the boot camp. And this is something else that I think everybody should write down because it's massively important for your mental well-being. There's a difference between I'm not trading well versus this is a tough market. Sometimes it's a tough market. Sometimes we're not trading well. Sometimes we are trading well, we're just not getting follow through. And again, that's stuff you write down in your journal. So in reference to this, NLS was well bid, entered at $28 on November 6th at the stop loss for $25.50. So if we look at that trade, we're talking about here, stop loss down here. Very, very well put together, Maureen. Very, very well. We can't do anything about this over the weekend. The entire story changed. Absolutely nothing wrong with the trade. So the point that I'm getting across here is don't doubt your decision-making ability because of, I'm going to use this in the context, because of a black swan. There's no way in the world anybody would have known that over the weekend or heading into Monday morning that this news was going to get announced. Your idea was solid. I want to make sure you understand that. The idea was solid, okay? Okay, so I got most of the questions in here. I'm going to close that out. And we're going to jump over into the questions here. Let's see, John, you posted about 6 questions. I want to give everybody a chance to have their questions answered. So I can't take up 6 questions for one person. I just want to make sure that everybody gets their say here tonight. So let's see, Sarwat, welcome to the community. How would you describe the character of Amazon? Amazon, for the most part, has been in a trading range. It's very, very difficult right now to look at the stock and say, here's the question you want to ask yourself, okay? Can I look at the stock and say buyers or sellers are definitely in charge? Right now, that's day to day. So as I've been talking about in this stock for a while right now, I'm not doing anything in it because to me right now, the stock is not obvious. Even if we go out to the weekly chart, you can actually see the box and the tape change dramatically. So Sarwat, in my opinion right now, and this is probably the best way to describe the last 3 weeks, selling, selling, buying, selling. It's not obvious at all right now. We want this. So everybody in their minds needs to make the distinction between this, which is great, this, which is indecision. This is still good, but indecision. So that's what perfect looks like. These 2 weeks are great. Then we go into a box again. And we have 2 weeks, 3 weeks of indecision where there's these tiny candles where it opens and closes in the same spot, and then indecision again. And now what you're getting here is you're getting a mix of everything. You're getting an energy candlestick that's bullish, a bearish energy candlestick. You're getting indecision. You're getting indecision, indecision, indecision. Then 2 good weeks, you would expect follow through, and you get the complete opposite. You need to know personally, Sarwat, what perfect looks like so that you know when you're looking at not perfect. To get back to Jim's conversation, if it's not perfect, you need to stay away from it, but you personally still need to know what perfect looks like first. So I'm describing the character of Amazon right now as very less than obvious. So if it's less than obvious, what am I doing in Amazon? I'm not doing anything in Amazon. We talked about this in the boot camp today. I want to see something obvious, and I just want to piggyback that easy ride. And right now, we're alternating back and forth every other week. I'm not looking to do anything in Amazon right now because to me, it's not obvious. Let's see, Alfredo Rivera, how are you, pal? Do you set the opening range breakout the same way always? If no, how do you do it? Yes. For me personally, in the time frame that I day trade, I'm always looking at that first 15-minute window. The only other distinction that I might make is if the market's a little bit choppy. Sometimes you could branch it out to the opening 15 minutes, but generally speaking, actually, I take that back. Definitively speaking, it's the opening 15-minute window for me. And if you're not familiar with why we do that, it was actually mentioned a little bit earlier tonight. The fact that opening price action can be whippy, it can be choppy, it can be hard to get a feel on it. When 15 minutes of the market expands and finishes, you can get a pretty good idea. Are we going to get a trend? Are we going to stay choppy? Once you start to trade outside of that opening window, you start to get some pretty clean follow through. And that's where the easier trading decisions come in. So Alfredo, I'm going to also finish answering you in a little bit of a different way, which is the easier it is to read, the easier it's going to be for you to trade. So that's why the opening range breakout is there. Okay. So let's see, John A. Let's answer John. He had a few questions tonight. What are your stop loss levels for a day? Generally speaking, general levels for day traders, the moves are so fast, they get crushed a few times in August, September, because it moves so fast the other direction if possible. So I want to answer the question in kind of a little bit of a different way. First, we're going to talk about August. Okay, August was a month where money was very easy to be made. We basically went vertical for August. So you could start here and go here. There were very, very few pullbacks in August. Matter of fact, I don't think the entire month did we have 2 days in a row that closed red, which you can actually see here. It's when the tape changes that you need to make adjustments. And again, Sammy is asking you, what happens if we go into a bear market? Will there always be long trades? Yes, Sammy, absolutely. And I'll get to that in a second, okay? So what I want to get across here, John, is number one, we've talked about the VIX. We've talked about volatility tonight. We've talked about how to use the VIX in reference to the trend. But you also need to be able to adjust your volatility to the current market, which means you have to adjust your stop loss to be wider if volatility increases. However, generally speaking, if the conditions change and you don't recognize it, those are the trades where you start to doubt your ability and say, I don't understand. I'm doing exactly what I did last month and I'm still losing money. But sometimes, and I guess August and September are the perfect illustrations of this. August was clearly bullish. September was clearly bearish. And if you were still only looking for longs that month and trading the same share size, it would have been very challenging to be confident in making money. So really, John, the definitive answer is stop losses are based on volatility. Day trading stop losses versus swing trading stop losses are completely different because, again, if we look at a 5-minute chart during the day, we could risk as little as this one 5-minute candle, which is 352.07 to 350. So this is roughly 90 cents, where you're not going to risk 90 cents on a swing trade. So you have to mentally be okay with the fact that day trading stop losses are based on the most recent price action, the same way that they are with the swing trade, but they have to be much wider. I know you had mentioned, John, about William O'Neill and those guys talking about 7 to 10% stop loss. I think they used 8%, if I'm not mistaken, which you might have typed in there before. that is way too big for a day trading stop loss. Look, bottom line is day trading and swing trading are completely different businesses, which require different trade management and different risk. On top of those parameters, as day traders, you can take advantage of a lot more opportunities by trading in and out of positions and trading for cash flow, where you can't necessarily take advantage of those many different positions as a swing trade, mostly because it takes a long time for those positions to unfold. So I'm going to move forward to Sammy. And this is Sammy's question is in response to what we were talking about before, to Virginia's question about only trading long, if that's all you're comfortable with. So Sammy's question is, what happens if we go into a bear market where there'll always be long trades? First of all, Sammy, yes, there always will be trades. Now, will they be fewer? Yes. Obviously, during August, pretty much everything was going up. Pretty much everything. But if we zoom out and we have criteria, even during this down move, you might not have longer term opportunities, but there are going to be some swing trading opportunities if they meet the criteria. But Sammy, I want to take this even further. Now, let's assume we're not buying puts. So let's just put that into the equation. So if the market's going down, let's just assume we're not going to get into options trading, because tonight we're talking about Stock Trading Pro, we're talking about stock trading. I can't emphasize this enough, and this is for Sammy and this is for everybody. If the market's going down and you're personally managing your own capital and you can't find any good stocks to buy, be in cash. There is absolutely nothing wrong with being in cash, waiting for the market or your favorite stocks to bottom out, and then look for better opportunities to be a buyer. So, Sammy, I'm going to say this in context, so please don't take this wrong. There's no reason to always be looking for a trade. We should always be looking for a trade that matches our criteria. So I know you're in the boot camp with me, Sammy. I will do my best to make sure that we find the best ideas. And if the market happens to be going down, we won't have that desire to be placing trades on the long side because that's all we're comfortable with. We'll only take trades on the long side because they're good opportunities to buy stocks. Okay. But that's a good question, Sammy. Really good question. Let's see, Nasir. Can you discuss the value of a trailing stop which is moved automatically versus a hard dollar value stop loss that one sets at purchase? That's actually a very good question. So you're not really going to set your trailing stop loss when you buy it, because you can't set a trailing stop loss until it actually moves in your favor. So let's just make sure we got the terminology down correct. But Nasir, generally speaking, what we talk about during the day is we say the very first one is, let's just say a position, let's just say for argument's sake, we're looking at this rally here in the SPY. At some point, if you bought down in this area and now you're up 1,000, now you're up 2,000, now you're up 3,500, now you're up 4,000, the dollar value at some point mentally has to be real money. And this is the way a lot of experienced traders trade. They never try to catch the top. They never try and catch the bottom. They want that meat in the middle. And you eventually get to a point where you say, you know what, I'm up $4,000. There's no way in the world I'm walking away with less than 3,500. This is real money. That's 2 months of mortgage payments. I'm going to walk away with real money. If you decide on that dollar amount and it starts to go higher and higher and higher, that's when you could put in a trailing stop. I generally use a percentage trailing stop as opposed to saying I'm going to let it pull back a quarter or I'm going to let it put it back $1, because percentage moves are generally, not generally, they are related to the dollar amount of the stock. So 2% move in a $346 stock versus a 2% move in a $50 stock, going to be very different volatility, but it's still 2% of each of those stocks. So Nasir, the first part would be, what dollar amount do you want to walk away with a trailing stop? So you can look on the chart and say, okay, I'm not letting it go below that $50 for argument's sake, because that'll keep 3,500 in your pocket. Or once it gets up to that level, then you can say, okay, I'm going to let it keep going, but if it pulls back 2%, that's where I'm going to have my stop, my trailing stop. So good question, Nasir. You know why that's a good question? Because you're asking trade management questions. That's where the money's made after you put that trade on, learning how to manage those positions. Yeah, Maureen, I'm actually just seeing your comment now. You're welcome. Yeah, there's a big difference between you put a good trade on that loses money versus you put on a bad trade that loses money. There was absolutely nothing wrong with that trade. Absolutely nothing wrong with it. So John, again, if I didn't answer that specifically, day trading stop levels are related to the most recent price action. There's really no other way to put it. And if I don't know if you remember the boot camp, because I don't know what John A is. I don't know what your last name is. But generally speaking, the stop loss for day trades are built around the entry signals, which is that most recent price action. Okay. Let's see, Jane, adding to the opening range questions, would you ever recommend canceling a stop loss order prior to the market open because you expect a volatile open to protect your positions from a very aggressive stop? That's a really tough question. So Jane, I'm going to give you the honest answer. If I said no, that I don't do that, I'd be 100% lying. And we're friends, so I don't want to lie. There's absolutely been times where I'm like, oh gosh, it's so close to my stop loss. There's going to be whippy price action on the open. I really love the idea. And if I leave my stop loss in there, I'm probably going to get hit. And I don't want to get hit because I really like this trade. Raise your hand if that's happened, because I'm telling you right now, it's definitely happened to me. Obviously, it's happened to Jane. She's feeling the same thing. So Jane, here is what I would do. You love the idea. You're fearful that opening range volatility is going to take you out of the position, which means that the trade is either pulling back on a profitable trade or it's a stop loss that you think is probably going to get hit on the opening action, but you think that the trade is still a good idea. What I would do at that moment is I would put a different stop loss in for less share size, be completely okay if I get taken out on a wild move against me on the open. And if it moves back in my favor and does exactly what I thought, I'd have no problem putting those shares back on. Look, everybody, I can't explain how fortunate you are to be trading in this environment right now where there's practically zero commissions to trade stocks. Zero. Think about that. Commissions really don't matter that much anymore. All you have to do is not mess up the process. That's trading for free. You're really just trading. Can I make money versus not lose money? So Jane, in this example, all I would do is put in a different stop loss with lower share size. So when I say different, I mean, it's not different in the spot. It's different in the share size. So you might not get taken out of the whole thing, get taken out of some of it. Okay. Let's see. Yep, 8%. Okay, yeah, John, that's what I thought it was. I haven't read his stuff in a while, but gosh, his book is really awesome. How to Make Money in Stocks. Very, very good. Very, very good. Yeah, look, Jane, if there's one thing you can definitely say, I've gone through all the pain. I've definitely gone through all the pain. So I don't lie about my own losing trades, history, whatever you want to call it, because that's really what makes you, when you start to get the losses under control and understanding, you value that. It's kind of like trading scars. I wear all my trading scars with pride. So I tell the truth because I want everybody to really, I want everybody to really learn from my mistakes. And that's really the whole point of us being together as a community. If I can help you avoid the mistakes that I did and help walk you through profitable positions, that's really where I think I can make the biggest difference for everybody is no, don't do that. And then get to the other side, like Jim said today, oh gosh, I can't wait to get to some trades. We can say, hang on, we got a good one on the line. Look, trading's not easy. It's simple, but it's not easy. And I really feel like that's the biggest part of our community is that we're comfortable in the community where everybody can ask a question knowing they're going to get an honest answer without fear of being afraid to ask the question. I really think that's the most valuable part of what we have together. So all good questions. Let's see, Nasir pointing out any other tools to subscribe to for effective trading knowledge. How about simplywallstreet.com for fundamental research? Yep, I guess that's a good one. I personally haven't used that. We could pull that up and take a quick look. Okay, yeah, that's kind of cool. That's kind of cool. I've never used it, but thank you for sharing that, Nasir. Really appreciate it. So anyway, I think that's all the questions that we have for tonight. Virginia, very good questions tonight. And Sammy, same thing. Again, if you're not comfortable short selling stock, just admit that and only run the business that you want to run, which is looking for spots to buy. And I think you'll be very confident in doing that. And by the way, Jane, I'm interested in hearing over like the next week or so about what we discussed in the coaching call last night and how that's affected watching the open over a period of time. It's going to be pretty exciting to hear how you're using that information to sort through a big list of stocks and focus on only the ones that matter to you. So I'm excited to see how that unfolds over the next few weeks. So, all right, everybody, I'm going to call it a night. I think that was a pretty good call. Sammy, have an awesome night. Thank you so much, everybody. Really appreciate you being here tonight. And thank you so much for participating. That's really where honestly, I used to say it all the time, how you spend your spare time will dictate how you spend your future. And you just spent your spare time learning and getting better. So that matters. If you think being here tonight is just something that's not that, it means a lot that you just spent this time after hours. Trust me, all of this kind of education adds up. So have a great night, everybody. I will speak to you soon. Thanks so much for being here tonight.